Welcome back onto an exclusive conversation then. Jonathan Garner from Morgan Stanley, the Chief Asia and Emerging Market Equity Strategist, is joining in on the show. He has long argued that India stands out among emerging markets thanks to the strong earnings growth, a robust domestic investor base and an improving macroeconomic backdrop. And Jonathan, firstly, thank you so much for joining in. And what a fitting day to have you as well, because the Nifty and the Sensex both are at record highs today. Well, the first question, Jonathan, to you, you may be at record highs, but on a year-to-date basis, the Nifty is still up only 11%. Compare that to a lot of the other Asia-Pacific benchmarks or even the global benchmarks for that matter. The index is still an underperformer. But would you think that with the changing macros, with the policy announcements that have been made, the foreign investors which have long stayed away from a market like India will finally start to make a headway back into Indian markets, especially because of the fact that we have been underperformers?
Yeah, so India outperformed 4 straight years, 21, 22, 23, 24. So you're right, there's been somewhat of a give back in performance relative this year, though obviously the absolute returns have been there to some extent. As that's happened, the valuation relative has fallen substantially from about 1 standard deviation above long run average versus other emerging markets to about 1 standard deviation below. And I think the reason that relative derating happened is that relative earnings growth momentum slowed. So we had a marked pickup, particularly in North Asia in markets like Korea and Taiwan, which are very rich in terms of semiconductors, tech, hardware plays on AI, and to some extent, some limited extent in China. Nominal GDP growth slowed in India, slowed probably more than we thought at the beginning of this year. But as we look forward, our economists are resolute, and certainly, as you just mentioned, the market's starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. I think on the other part of your question, I think often when I've been on your shows, you've asked about the foreign investor, the FIIs. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year.
Jonathan, hi, morning. What's the overarching view on Asia and emerging markets? You know, as we were discussing, emerging markets have come off an exceptionally strong year, particularly, say, a Kospi. That's up 66%. But the gains are concentrated. It's led by AI, semis, all the technology plays. So first, if you could tell us the big view on emerging markets going into 2026, what do you like, what do you not like, and why? And secondly, if the AI frenzy were to cool, not a bubble, pricking or bursting, but just some moderation in the optimism, then how does it affect the dynamics?
Thank you. That was another 2-part question. So I'll try my best to remember both parts of the questions. So I think the first part of it about emerging markets overall, I mean, this year we had a tailwind from a weak dollar, particularly in the first half, and that eases financial conditions in emerging markets. We had a lot of multipolar world dynamics, as we call it, the whole trade and tariff debate. And that certainly around April, May caused almost all markets to fall. When we actually... Sorry, I can hear some feedback. When we actually go through the second half of the year, it's right, that dispersion in performance was very significant. But going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small. And most of our other market calls are relatively contained. And we're just arguing that to have a robust approach, investors need to focus on stock picking and they need to be quite nimble. We're not done with macro volatility globally. We're living in very uncertain times. So it's not a sort of a bang the table opportunity on any individual larger market here for us. Thank you.
Jonathan, coming to India itself, before I get into macros and the sectors that you like, Maruti, that is one stock that is on your focus list, right? I wanted to understand what do you like about it right now? You called it a potential beneficiary of the GST reform and product pipeline strength. So what differentiates Maruti today versus 2 years back when we were talking about it suffering from the EV threat? What makes you so bullish on this one?
Yes, I mean, in terms of talking about individual stocks, I don't tend to do that on these because we have analysts that cover them. But what I would say is that it's in the right space in terms of GST, it's consumer discretionary. So when you get these cyclical upswings in activity, it's the kind of thing that tends to work well. And obviously, it's a stock that our analysts cover and that we know well.
What about sectors in general? You have highlighted more upside in, say, financials, industrials, and consumer discretionary. What is the strongest bottom-up signals that you're getting from these three sectors that make you bullish here?
Obviously, we work closely with Rhythm Desa and the team on all of this. And yeah, we're overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan, you mentioned we are living in uncertain times and the fact that the macro instability is not over yet. But India as a economy in general has had relatively stable macros, right? Because the first quarter GDP print was fairly robust, almost close to 8%. Polls for the second quarter GDP are also indicating a similar sort of print at around 7.5%. Do you see this economic stability as an outlier compared to a lot of the other global markets, or will this uncertainty around this trade tariff deal with the US be a bit of a dampener going into the second half?
Yeah, so actually the drop-off in inflation in India is important. I mentioned in answer to your earlier question, nominal GDP growth, which matters much more for corporate top line than real GDP growth. And I think that's where the negative surprise came in. I think effectively the decline in inflation is telling us that policy was too tight. And likewise, credit growth actually falling to low single digits. This is not what one should be expecting from an economy that is still developing very rapidly. So what we're anticipating, hopefully, is that with the policy easing measures that we've had, the nominal GDP growth environment will accelerate, as I said, from kind of mid-high single digits to mid-low teens in the course of next year, and that will reignite the corporate earnings profile, which softened relative to those markets we talked about earlier that had a very strong year, the AI, tech, semi-capex kind of markets. They, by the way, are likely to continue to post strong earnings growth next year, maybe decelerating somewhat, but they will still be growing earnings next year.
Jonathan, would request you to hold that thought. Would love to continue this conversation on the other side, but just need a mandatory short break.
Welcome back. You're still tuned into Trading Hour. We still have with us Jonathan Garner of Morgan Stanley. Jonathan, we have been talking about how global markets have been faring, a lot of macros as well. You are seeing some upside for Japan as well. But, there's some nervousness around yen carry trade. We are talking about yen strengthening, yields are jumping. Do you think this is something which could impact markets globally and Asia as well?
In a word, not really. In a sense, what we're seeing is a normalization of yields in Japan from very low levels, consequent upon the BOJ intervening less in the government bond markets, which is a very healthy development, and the fact that reflation is ongoing. If you look at Japanese 10-year yields, they're about 1.8%. That's still less than a half 10-year yields in the US, for example. And if you look at the underlying situation vis-a-vis the yen, it's actually strengthened this week after we got the details of the fiscal package. And the fiscal package itself is entirely financeable. Japan is amongst the G7 almost unique in running essentially a balanced fiscal position relative to GDP. It's less than 1% of GDP fiscal deficit. So it's more than able to expand its fiscal impetus here. So the yen is undervalued. We think it will strengthen back towards the mid-140s over the next few months. And I think that process began in the last few days.
Jonathan, at Morgan Stanley, how do you all assess the risk of an AI bubble?
Well, I think that's far too broad a term to use. Certainly in recent trading, we're seeing more performance relative activity at the stock level. When we model out the impact on particularly what we specialize in, which is things like the upstream exposures in markets like Japan, Taiwan, and Korea, as I said earlier, we're anticipating continued strong earnings growth, particularly in the memory names, which are very dominant in the Korean market, for example, at least for the next 12 to 18 months. So, within the Asia coverage that we do have some recommended stock exposures in our focus list to it. And overall, yes, it's a sector that's trading on very high valuations to its own history, but it is also exhibiting by far the highest ROE of any sector in our coverage right now. These major companies in Asia are generating 30% ROEs. So obviously they're the equipment suppliers to the infrastructure build out that's going on in the sector globally, and they're doing very well.
Back to India, overweight position, but you are recommending a tight risk position. Can you elaborate a little bit more on that and what you expect in 2026?
Yes, to be precise, we're 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000, but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1,400 target.
And what's the bull-bear on the Sensex?
76,000 up to 107,000. So quite a wide range. And that's a feature of markets globally, and we talked at length in our year ahead report about that. If you think just about this year, from early April to now, the EM index is up around 35%, and the Topics index is up over 40% since early April. So we're not, in a sense, in normal times for the kind of performance that we can get, the performance volatility we can get.
Jonathan, come December, you would expect that activity would cool down and people would go on holidays. But the 2 major policy actions that are lined up, at least for our own markets, one being, of course, the RBI policy, and then, of course, the Fed decision on the 10th. Firstly, considering what you spoke about for the Indian economy, you mentioned that earlier policy rates were a little too tight. Do you expect further easing from the Reserve Bank going into this policy and in 2026? What are you pricing in for that? And the same for the Fed as well. Do you see a rate cut on the 10th? And what policy actions are you pricing in for 2026?
So if you start with the RBI, yes, we do expect a 25 basis point rate cut. After that, we'll see on hold probably for a while. In the case of the Fed, it's very balanced. The probabilities are moving around almost by the day. But in the most recent note from my colleague Michael Gapin, he counts, I think, 5 Fed governors as in the no rate cut camp, 4 as in the cutting camp, and 3 as agnostic or undecided, including the chairman of the Federal Reserve. So it's very delicately balanced for the Federal Reserve.
Hey, Jonathan, a pleasure speaking with you. Thank you so much for joining us today with your insights and the outlook on markets, EMs, and a lot more. That was Jonathan Garner of Morgan Stanley. With that, we'll slip into a break. But as we do that, here's a quick programming note. If you're looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Sumaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. Ask your questions questions live on 28th of November at 1:30 p.m. Become a member today on the CNBC TV18 app or log on to cnbctv18.com/access/plans.